Hello, good afternoon and welcome to HYCM's webinar FX Week Ahead Live Market Analysis with myself, Giles Coughlin. I'm looking forward to taking us ahead and looking forward to what we have in the week. It's a busy week in the FX markets, so there's a lot to cover and there's a lot on. And I'm going to try and focus on the most relevant things for us as we're going into this week. Before I get going, it'd be great if you could just let me know if you can hear me okay. If you could just type in the questions, make sure I'm coming across okay. I'm double checking that my screen is sharing, so I can see that's coming across. Just if you could type, yeah, okay, Kenneth, that's super. I'm glad that's coming across okay. Before we really get going, this is just a quick disclaimer that I want to run us through. And this is simply explaining that as we're looking at different market scenarios, different entry, exit levels, technical places, the idea of this webinar is not to be giving a signal service or providing trading advice. Instead, the idea is to give you the understanding of how I go about looking at the financial market, so you can begin to see risk events for yourself. You can start to understand how to apply some of the skills that we'll be learning during this webinar and the workshop on Tuesday for yourself into a real day-to-day market scenario. However, the idea is it's education rather than advice, and there's good reasons for that. And mainly it's because the market situations can change so quickly. So what can be a great idea on Monday could be terrible on Tuesday, and sometimes even with the same day. So it's just important that you grasp that for your own benefit, as well as a legal disclaimer that we have from our end. That's just a good bit of information for you to make sure you understand. And so we're looking at the week ahead, and as always, before forward, we also want to make sure that we're looking backwards. And before we look at the coming week, we're going to look at what happened last week. And one of the most important events last week was the European Central Bank met for their rate meeting. And during that time, they kept their interest rate on hold, which was widely expected. And in this scenario, the market was really looking forward to seeing what the European Central Bank had to say about the state of the Eurozone economy and where the European Central Bank saw their relationship in order to either raise or cut interest rates. Now, what they'd explained, you can see here, this is one of their monetary policy decision press release from last week on the 24th of January. They said that they expect the key ECB interest rate to remain at the present level at least through the summer of 2019. And in any case, for as long as necessary to ensure the continued sustained convergence of inflation to levels that are below but close to 2% over the medium term. So that was the expected part of the meeting. This is what the ECB have been saying. We're going to keep interest rates as they are, but then we want to raise them in the summer of 2019. So that's, the market was thinking, well, because the Eurozone growth has been slowing down, looking at the purchasing manager index for Germany, Italy, Spain, they've all been slowing down, showing a slower Eurozone growth. So what the market was thinking, well, is the ECB going to cancel or extend that 2019 interest rate hike? And what actually happened is the ECB said that they started to give some soft tones, and I'll show you, they gave a mixed message as you looked into the detail of what they're saying. So what they said was, I've highlighted it in bold for us. They said the incoming information, and that's referring to the weaker growth in the Eurozone, so has continued to be weaker than expected on account of softer external demand and some country and sector specific factors. The persistence of uncertainties, in particular relating to geopolitical factors and the threat of protectionism, is weighing on economic sentiment. So there, the ECB was acknowledging some of the slowdowns that they've been experiencing, and they were saying, that's happened. And they actually also said during the meeting, during the question and answer session time, Draghi said that the market had correctly understood the way the ECB was giving forward guidance, because the market's probability of rate hikes was pushing it back to the end of 2019, maybe even to 2020. So Draghi was recognizing that there's some negative drags on the Eurozone economy, but also he said at the same time, so he gave quite a balanced message, he's talked about supportive financing conditions, favorable labour market dynamics, and rising wage growth continue to underpin the euro area expansion and gradually rising inflation pressures. This supports our confidence in the continued sustained convergence of inflation to levels that are below but close to 2% over the medium term. So essentially he gave quite a mixed message, and that mixed message was really trying to weigh up those two different aspects of what the European Central Bank is trying to balance. Manufacturing is slowing down. We covered on previous sessions how global growth is slowing down. We've had the Chinese nation has been slowing down their manufacturing. Their purchasing managers index have been heading on a downtrend for some weeks and months now. So the general slowdown is also affecting the European Central Bank, and a number of nations are showing slowdowns, which is what you'd expect if there is a global slowdown in growth. But at the same time, there were some positive factors for the European Central Bank. So now, looking forward, we have the ECB meeting this week, and what's going to be key this week is thinking, well, how does Mario Draghi, the ECB's president, how does he continue to tweak this message he's begun to share with the market? Because it's a more negative message for the euro, and we saw last week that the euro was selling off, and at the end of the week it was just rising a little on the back of US dollar strength. But the bigger picture is that this is an acknowledged slowdown from the European Central Bank. So that's one thing to look at. We can refer back to that during the webinar, so just keep that in your mind. Okay, now the next issue was the US government shutdown is over. That was a relief to markets, but not a massive relief, because it doesn't particularly weigh on the US economy when the US government has shut down. I've shared in previous weeks that there isn't very much of an impact on the Standard & Poor's 500 US indices during a US government shutdown, and as a consequence, this shutdown was beginning to raise questions because it was going on for so many days. But now with that over, the market can get back on, and it wasn't particularly factoring that aspect in. But it may affect data out this week, so that's one thing to be aware of as we look into the specifics of what's going on this week. After last week, we had the Germany January Business Climate Index on Friday, the 25th of Jan, and you can just see that was one of the lowest figures since May 2016. You can see that 99.1. Now, Germany is very important for the Eurozone because it's the largest economy in the Eurozone. So what's bad for Germany, it does drag on the entire Eurozone. So on Friday, they had a business climate index which had dropped below 100, 99.1. And you can see that large drop here from sort of a year ago, December 2017, where it peaked. It's now on a firm downtrend, breaking through those lows of March 2016. So that's after Draghi was acknowledging the slowdown in Eurozone growth. So that is going to be continuing to weigh on the euro. Now, the star performer at the end of last week was the pound. The pound rallied nearly 2.52% against the US dollar, and the reason for the pound rallying for so much was on the market was pricing out the prospect of a Great British no deal with the Eurozone. That is what all this appreciation on the pound has been. When we look at the pound chart, which we have here, you can just see that over the last few couple of weeks, especially last week, to that very large bullish bar right into the 100 exponential moving average. That was a 2.52% rise, and you can see we were looking at potential targets last week when price was around here. We looked at entering with stops just above the lows and taking profit at the 200 exponential moving average. You can see that trade came off very nicely and actually overperformed, breaking through the 200 exponential moving average quite clearly. And then I was looking at another potential of getting long here at the mid of last week and playing further up to these highs. There's a 200 simple moving average on the daily chart that's just a little bit higher. So that's what was going on during with the pound. That's why it was rallying so strongly. The market is beginning to think, oh, there's less chance of a no deal going on. And many market participants are saying that the pound in its fair value is about 1.35. So many people see 1.35 and above as fair value for the pound once the Brexit no deal scenario is eradicated. So that is where the market was heading. It's making that way up, and I can see, looking forward, there's a lot of volatility ahead for the pound, but there's a few key places where you can enter short and longs depending on what's going on. So using the moving averages to define and limit your risk can be a very sensible way of trading the pound at the moment. But we'll go through it and see some of the volatility that we have, and I'll explain some of the reasons for the volatility. So if we're going back to our PowerPoint, our keynote here. So Brexit is very much in focus looking at this week. Now, one of the largest events this week is that the British Parliament is set to meet on Tuesday, okay? And on Tuesday, Theresa May is set to give another vote for her Brexit deal, and there's a number of amendments that are being proposed. Now, these amendments are very important. There's a whole selection of them. There's about a dozen or so amendments. And the main thrust of the amendments is to do two things. It's to, one, extend Article 50, which is essentially giving Britain more time to work out a deal. That's number one. And number two is to remove the prospect of a no deal. Everyone agrees that a no deal scenario would be very poor for the pound. So if it gets to Tuesday, the more likely a no deal scenario becomes, the worse it is for the pound, okay? So the reason the pound was rallying was on the expectations that a no deal was being factored out. That's why it was rallying strongly. However, there still is the chance of a no deal happening, albeit a marginal chance. And so the market is now focusing in on that risk this morning, and it's concerned about a no deal. Now, the EU reiterated again that the withdrawal agreement is not open for changes. They said that again this morning. They've been saying it over and over again. And the real difficulty for Theresa May is over what's known the Irish backstop problem. Now, this is to do with a border between Northern and Southern Ireland. Because if Britain leaves the European Union, Southern Ireland remains in the European Union. So there would have to be a physical border between Northern Ireland and Southern Ireland, because Northern Ireland is part of the United Kingdom. It's part of United Kingdom, and as a result, if the Northern Ireland remains a part of Great Britain, which it will in the United Kingdom, Southern Ireland is the European Union, so there will be a hard border. Now, there's a number of different reasons why this. There's a number of different reasons There's a number of different reasons why this is the case, okay? And the reason this is the case is in Northern and Southern Ireland, there's been a lot of problems over the years. You may have heard about it, called sectarian violence, and going back into the 90s and the 80s and the 70s and beyond, many people lost their lives in skirmishes, bombs on mainland Britain. There was constant tensions between Northern Ireland and Southern Ireland, and many people, very sadly, lost their lives. Very terrible, tragic consequences. So everyone's really keen not to see a border being erected again along that Northern and Southern Ireland area, because people don't want to see those tensions, and the border will kind of play into certain parties' hands, and it is quite a complex political issue, and one that is highly fraught. So people are very keen to avoid that. That is why Theresa May is having so much difficulty with this hard border problem. So what we need to look for is solutions around that Irish border. If there is a solution, and I think the one solution that makes sense for me is if the European Union give Britain the option of a sunset clause. Now, a sunset clause is basically a clause in a contract that says there comes a point when a certain part is no longer relevant. So in this instance, it would be saying, yes, if you can't work out a deal, we will have a hard border between Northern Ireland and Southern Ireland, but there's a sunset clause and that it expires after sort of 5 years, 10 years, something like that. So there's a limit to how long that scenario could actually be valid and be live. That, I think, for me, is the most likely outcome of the agreement, but it's very fraught with difficulty. And there's one thing that there's certain in this is there's volatility ahead. That's quite a large difficulty, having that volatility coming ahead. And remember, if it's a no deal scenario becomes likely, then the likely path of the pound would be down through these 1.18 levels. We could be looking at 1.2 and 1.15. Okay, so just to let folks know, and as a kind of as a warning in terms of volatility, if that happened, the volatility is very large and liquidity can be limited. So you have to be very careful trading in that scenario. You can have huge moves. So you might think, the pound is very vulnerable at the moment, so I want to keep out of pound trades at the moment. Or if you do trade the pound at the moment, be aware that you can have large moves, and so adjust your risk to allow for those large moves which might take place. So there's opportunities and there's dangers ahead for the British pound, as there often is in these market conditions. Now we come to Monday morning, and we see obviously that at the moment we have the yen is the strongest alongside the euro. We have the commodity currencies have been sold off. Now the Nikkei was down 0.60%, and we have the S&P 500 futures down 0.40%. FTSE's down 100%. We have the DAX down 0.19%, and so the market is in a kind of a gentle risk-off mode. The yen's being bought, the commodity currencies are being sold. So we've sort of gone into a slightly risk environment, which isn't surprising given the concerns that we have out of Europe. You look at US-China trade war negotiations. We see particularly the problem there is with intellectual property. That US has a number of grievances with China about the alleged stealing of intellectual property. We have a whole range of issues. The US government shutdown has stopped now, which is good for markets, but we have a US-China slowdown in growth. And so the market's really trying to factor in these levels of risk. And so we're in a I've been saying this for a few weeks now, and it's still the case. We are kind of in a crossroads situation. Either China and the US are going to make friends, that trade war is going to end, and then the foundations for ongoing global growth are going to be reestablished, or those relationships are going to sour. We're going to see more trade tariffs, we're going to see slower global growth, and we're going to see more risk aversion from the markets. So that's the situation. Again, the pound today, I want to show this to you. These are the key risk levels that we have in the pound. Technically, we have a pivot point here on the daily chart. This, if If price is going to carry on going up, then a key place where you'll find buyers is at the resistant 2 level, which is also corresponds with the 200 exponential moving average around the 1.300 level. So in this kind of zone would be the first zone we'd expect on a first test. You'd expect to see buyers turning up again, potentially here on the 100 exponential moving average and the resistance 1 zone. So these two areas here would be potential buy areas if we think that the market, the Great British Parliament are going to arrange some kind of deal. If that's going to be sorted, then these are two areas for buying. If it isn't, then risk can be placed above the resistance 3 level, and we can play looking down to this level and potentially that level if this resistance level breaks. So they're the two kind of places. If you're looking at swing trading on a longer term scenario, there would be sensible places to define and limit your risk. And as I say, at the moment, because we just can't see what the market is doing, and there's so much volatility ahead, this is a time just for stepping aside and waiting after Tuesday, because after Tuesday the market will have some direction. It will become clearer what's happening. So the best way probably to play this is, if you're not sure of what's happening, is to wait till after Tuesday and see how the market's responded. That's going to give us the most likelihood and options going ahead. Now let's have a look at the calendar. I'll just bring the calendar across. Just bear with me one moment as I bring across HYCM's calendar. Here we go. Now, looking first off and foremost, we have Monday, we have at 2 o'clock GMT is our first interesting meeting. We have Draghi speaking. Now, this is a speech from Draghi, and the market will be looking at this speech to get clues from Draghi as to what's happening with the euro. Okay, so 2 o'clock, wait till trading the euro, wait until Draghi's spoken. He might give a clue. He might be saying, the balance of risks is meaning that we're very unlikely to raise interest rates next year now. Something like that would suddenly see the euro drop. Okay, so market participants will be looking. That is a key risk event for today. Make sure that you're listening to his speech. He's also speaking again at 4. So what you have to look out for these two different events is, if he says something at 2 and the market responds one way, he can correct or confirm it at 4 o'clock. So you have to take those speeches as a pair, because sometimes if the market overreacts, he'll say so at 4 o'clock. So that's a key thing to do with Draghi. We have the US consumer confidence on Tuesday. That is coming out at 3 o'clock GMT, yet consumer confidence. Now, this is the Conference Board's gauge of consumer confidence. It was standing at 128.1 points in December, off the peak levels, but it's still reflecting good mood amongst the American shoppers. And this is expected to fall this week down to 125 is on the cards. So that's going to be looking for the US dollar at how confident consumers are. The event that I think is one of the most significant events of the week, and potentially of most interest to us, is the CPI data that's coming out on Wednesday for Australia. Now, Australia publishes its consumer price indicator only once a quarter. So as a result, each publication is significant. Now, in the third quarter, both headline inflation, okay, here, and the mean consumer price index, both of them were 0.4%. Okay. Now, the year-on-year level is expected to drop to 1.7%. So there is a repeat of these numbers expected of 0.4% and 0.4%. Now, the general kind of a direction of the Australian economy has been tilting to the downside for a while. Now, one of the key relationships to remember here is that Australia's economy is very closely linked with China's economy. So if China's struggling, then Australia's going to be struggling. There's a strong correlation between the two economies. 30% of Australia's GDP is linked to its trade with China. Okay, so if things are going badly with China, things are going to go badly with Australia. So we can see why it's been slowing down a bit in Australia as China's economy has been slowing down a little bit. Now, just to show you some of that relationship, this is a chart that charts the relationship with the Australian dollar with Chinese equities. And you can see that as Chinese equities have been falling, then so too has the Australian dollar been falling. Now, the Australian dollar has recently been increasing with the Chinese equities recently increasing. So this is coming back to that crossroads that I was talking about. The pound could, the pound we've been looking at could be looking like it's going to be having better days, particularly if a no-deal Brexit is ruled out. And the underlying British economy is quite strong. The Australian economy is being dragged down by Chinese slowdown in growth. And if that US-China trade spat or tariff or war doesn't sort out, then that's going to continue to weigh on the Australian economy. So one thing we look at, and this is what we look at the workshop, is we're looking for two different scenarios. We're looking for one currency that's appreciating and one currency that's depreciating. And you can see straight away here that a pound Australian dollar trade could look very good at the moment. So a long pound and a short Australian dollar, that would be long pound Australian dollar. Now, so on Wednesday, if there's a significant deviation here, if that is a move to the downside, then that's going to weigh on the Australian dollar. So that's one to look at, and potentially could be good for trading if there's a deviation of about, anything that's about 0.3, 0.4% deviation of these two figures would be tradable straight off the bat, and anything that's a miss could be tradable later on, joining the scenario later. Now, the other significant event that I'm interested in is that's that one. It is the Thursday. We have the GDP data coming out of the Eurozone. So we got the GDP coming out here at 10 o'clock GMT on Thursday. Now, when you're looking at the GDP data, the fourth quarter, we're looking at 0.2%. The third quarter was 0.2%. What we're looking at is when we see this, we're seeing that there's this fall in the GDP quarter-on-quarter data. You can see, look, it's gone down from 0.4, then 0.3 in the second quarter, then in the third quarter 0.2. Now we're coming to that 2019. Staying at 0.2. So the general trend is down. So you're beginning to see a pattern here, and the pattern is a slowdown in the Eurozone. So there is a potential for this to surprise to the downside. If it does surprise to the downside, that's going to be more weakness for the euro. So that's potentially a trade. I'm looking at trading into that event potentially from Wednesday evening. I might be looking at Wednesday, looking if I can go short on expectations for this lower GDP number. So that's what I'll be looking at on Wednesday evening. Again, that's not trading advice, that's just what I'm going to be looking for. And the other information that's worth looking at is Chinese data that's out on the Friday evening. This is the Manufacturing Purchasing Managing Index. Now, this is slowing down again, and one of the things that happened is it dropped below 50 in December, 49.7. It's expected to drop further at 49.5, and so remember that this could be very interesting data in relation to the Australian dollar for the coming week. Get that correlation in your head. What's bad for China is bad for Australia. What's good for China is good for Australia. So you can see we're kind of at these crossroads at the moment. The market's really trying to understand which direction it really wants to go in. So we haven't got clear direction, so we have to be interpreting the data as it comes along at the moment. Now, on Friday we have the non-farm payrolls coming out at 1:30 GMT time. Now, obviously, the US government shutdown may affect some of these readings. So there's caution advised here. And caution specifically if there's a big deviation, just be careful, because quite quickly the market might discount it because of the US government shutdown and the way that's going to have twisted the figures. So be aware, there's a warning for the non-farm payrolls this Saturday. We also have the wages were very good. Like, look at the last month's data was excellent for December. 312,000 jobs were added. Average hourly earnings up 0.4%. Unemployment rate was good. Everything was very strong. So this month is not expected such a strong reading. We got 168,000 versus 312,000, and average hourly earnings expected to be 0.3% versus 0.4%. The market will be interpreting that data, but there is a risk event warning with that, to be skeptical of the initial release, especially if it's a very, very weak one, just to be aware of that coming up for Friday. So you have been forewarned, just to pause a little bit. Now, you may be thinking, okay, that's great. I can see the risk events. How do we begin to put this into practice? Well, that's one of the things that we do here at HYCM, is looking to show folks how to implement some of the fundamental analysis, the reasons why the market is moving, why currencies are being bought, why there's being sold, how to marry that together with technical analysis to find places where trades can be bought and can be sold in a way that's defining and also managing risk. Okay, so that's what we'll be doing on tomorrow, 1 o'clock to 2 o'clock at GMT time. And during that time, what we'll be doing is looking at specific market situation. I'm also going to be looking at a couple of swing trades. I'm going to be looking at the pound Australian dollar long and the euro pound pair short. And I'm going to be going through both of those trades tomorrow, as they're potentially good swing trades, in other words, trades that last for days and weeks rather than hours and days, which is your trading within the one day. So that's going to be happening tomorrow. And one of the great things about the workshop is that we do a raffle. And if you attend the workshop live, every person who attends the workshop live is entered into a raffle. And tomorrow we're drawing the raffle, and the one winner of the raffle will get a 1 hour session with myself, one-on-one. We'll together, I'll be asking you questions, and I'll be helping you to put a plan into action as to how to organize your trading, how to set up your thinking to be consistent and persistent in pursuing the foreign exchange markets as a business. So that's what I'll be trying to do, trying to help you to set up some key foundations that are needed to put you on that journey, on that pathway. We also run an offer where if you deposit $1,500, you get that 1 hour coaching session with me, and I'll be able to help resolve any personal trading queries you have. So if there's something you're struggling with, part of that 1 hour session, I'll be able to help focus those difficulties for you. Secondly, if it's a deposit of $3,000, you get the 1 hour coaching session with me, and you get 1 hour follow-up review. That's really helpful, because in the 1 hour coaching sessions, I'll often give people something to go away and work on. It's very helpful if you can have a follow-up review session to see how that went. And finally, for a $10,000 deposit, you get the 2 hour coaching session, you get the 1 hour trading follow-up, and you get 1 week VIP support from myself. And the way that VIP support works is it's just a way of almost like, commenting on maybe a trade you've taken. I've taken this trade, I managed it this way. It's just looking at just being a little bit, not holding your hand, but it's more being alongside you as you're going through the market moves. So that is what we have. Next week we'll have the normal webinar, 12:30 to 1 o'clock GMT, our 4th of February. And I very much look forward to seeing you again. Thank you for attending. And I hope to see some of you tomorrow at 1 o'clock to 2 o'clock for our HYCM trading workshop. Thank you very much, everyone, and have a good week. Goodbye.